We have what are called do-it-yourself investing. Now, back in the day when we were younger, a lot of us did our own investments. But as we get older, and as the financial gets more complicated, people will look to the expertise of working with some type of a financial person in order to help them manage that portfolio. And as we get older, it might be time to turn it over to a professional money manager, like a third-party money manager. And the other article that was in yesterday's Sun Sentinel is on personal money managers for people that mentally are unable to actually pay their bills any longer. And it's a whole separate industry that I really wasn't even aware of until I read this article yesterday. But they will come in, for example, say my parents who are in their, almost 90, and at some point, if they can't pay their bills, they could hire somebody to do this. Obviously, it has to be somebody that has either a CPA or somebody that's hopefully a full designation for this job description. It's kind of anybody could be a personal money manager to do this, which scares the heck out of me because people will be taken advantage of, the elderly. So hopefully the government will kind of wrap their arms around this industry and make it more disciplined so they have kind of a watchdog to watch over this. But that's very important. Now, with a professional money manager, you can have what's called an individually managed account, and it can consist of mutual funds or exchange-traded funds or variable annuities. Has everybody here ever heard of ETFs, exchange-traded funds? Anybody have not? Raise your hand, please. Yeah, this is something you want to be aware of. Ask your financial advisor about exchange-traded funds. We're going to give you some reasons why. Now, the advantages of a professionally managed account is they have years of investment research and expertise and experience. But a smaller investment, you can get better diversification. And some of these accounts are only available through a third-party money manager. It's not something you're going to read about, say, in Money Magazine or Forbes Magazine. But it's a great way to get professional advice at a very small fee. And it's a customized, diversified portfolio based on your risk and your goals.
What do you consider small?
They're going to range a money manager anywhere from, say, 50 basis points to 100 basis points. So that would be anywhere from 0.5% to 1% on most portfolios, depending on the size. And then there's a difference between what's called strategic and tactical active money management. So strategic is more passive, and tactical would be more active. So there's a range based on that, and then there's a range based on portfolio size. The more money you have, the smaller percentages that they were charging. So they have what are called breakpoints. Like you're paying less as you have a larger portfolio. Similar, you can get breakpoints in mutual funds. So if anybody here invest in mutual funds? A couple of people? Check to make sure, because as you're adding money to your mutual funds, they have what are called breakpoints, where they should charge you less as you get up to a certain dollar amount. So check with your advisor to see if you qualify for any breakpoints. They don't always tell you about it, but you're eligible as your account gets larger. So with an individually managed account, the investor actually owns each investment inside that portfolio. It's not a mutual fund where it's a pool of money, where it's a pool of stocks. You don't actually own the stock in the mutual fund, but an individually managed account, you do. And the investors in their accounts are not affected by the action of other investors. It's still your own individual account, and you only pay taxes on the capital gains that you realize, as opposed to that mutual fund, which might be tax inefficient because they turn it over. Every position might be turned over 2 or 3 times in a year, which could be a taxable event. So you could actually pay taxes when you're not making money on the mutual fund. That's not a good thing.